Hey everyone, this is Josh here with Invest with Matt. I hope everybody's had a great Thursday and is looking forward to Friday and their weekend. Today, I wanted to go through a few charts that I've been seeing floating around. I've formatted them a little differently just to make the visualizations easier. Uh, so we'll walk through them here. It's really just a macro level view of things, more of a vibe check. I know the market has been up of late, but with the tariff back and forth, I think there have been some jitters over the past few days. Um, Personally, I don't think it's a whole lot to worry about. But, when you have large amounts of money floating around, maybe tied to your retirement, tied to, money you want to put towards a house, towards an engagement ring or wedding. Stuff like this can make you nervous when you see fluctuations of 2 and 3% intraday. Like last night, we had the courts block the tariff news, and the market got really excited and was up. S&P was up almost 2%. Nasdaq was up over 2%, and just as fast today, it reversed on the news that obviously Trump is going to appeal. They think they have ways that they can still circumvent these smaller courts' decisions. We had the court in New York, and then we had another court come out in, I don't even remember where it was at today. A toy store, I think, had filed. Um, to have the tariffs delayed, and then they came out for like a 14-day delay. So now we have two instances of courts ruling to delay the tariffs. Now, well, whether that stands or not, I don't know. I don't know that it matters. The market was already kind of starting to digest that fact. Like they were starting to get comfortable with the idea of tariffs. Negotiations had started. We had already started cutting back on some of the tariffs. Some of the other countries had cut back on their tariffs. The retaliatory tariffs had been cut back. So it really just didn't seem like that big a deal. Obviously, if it were dropped altogether, that would be a major boon for GDP and reporting for some of these companies. But that's just not the case right now. You know, well, let's look at the charts here that I got for us. I will not belabor the point. So the first one I have up here is the VU monthly journey as its title. Really, this is just showing you the inflows into VU ETF, which is the leading ETF for, like a total market index. This is similar to what most people think of would probably be SPY, or for like the NASDAQ QQQ. But VU is the most popular. This is the Vanguard S&P 500 ETF. This is just the cumulative rate of return versus the fund's inflows. So how much money is being inflowing to the funds? This is just people who are either directly depositing a portion of their paycheck into a 401k, or it could be self-directed where people are putting in a certain amount every month. This is just a very popular for retail and for passive investors. It's a good like health check on how the general population is saving for retirement. And it's really unique because year to date, VU has more or less gone nowhere. If you look at the rate of return and this comparison here, I do have it where it's split out by each year. But we'll just, for the sake of time here, we'll do the compare all so that we can see them all in one spot. I think it's easier to visualize this way, to make the point anyways. So looking here at the 2025 return, we basically got nothing this year. It's like 0.2%. It's flat. Whereas the previous years in 2023, we saw 8.7%. And in 2024, we saw 8.8% through May 29th. So this is significantly underperforming this year. I don't think anyone could say otherwise. But if you look at inflows, no one really cares. Outside of March, which was slightly lower than 2024, and then outside of this current month, which is significantly lower, but on aggregate, you see it's higher 3 out of the 5 months. Inflows are more or less unchanged this year, and they're higher every single month since 2023. And 2023 was a year where we had 20+% returns. Same with 2024. And here we are in 2025 with inflows. Let's see where they're at right now. Year to date inflows for 2025 is 39.5 billion. And we're only, we're not even halfway through the year yet. I think they were 86 billion last year. So we're on, track for roughly the same return as far as inflows go. Now, as when it comes to the actual return on that investment, well, it's significantly lower. Almost 9% lower relative to the last 2 years. This is just an interesting fact because this trend of people just shoveling money, whether it's retail, um, or institutional, which I don't think it's institutional. I think it's just people just depositing, on a regular basis, you know, from a financial standpoint. I mean, people are more educated today than they were in the past. I think more people have 401ks. I think more companies are providing this. I think more companies are providing matches, which incentivize people putting money in. And that's what you're seeing here. People don't really care what the market's doing. They're still every 2 weeks throwing money into the fire. They know it's going to compound over a 30-year period. They don't care. They set it, they forget it, and they come back in 40 years, they take it out and they retire. And the financial literacy has only helped with this progression for the majority of the population, at least here in the United States. I think overseas, saving via the stock market isn't nearly as popular as an investment strategy for people's retirements. And frankly, they probably don't need as much money to retire because the cost of living isn't as high as it is here in the States. But you can see here, I mean, it's pretty obvious. Lots of money going in, you're getting very little in return. People don't care. They're still putting money in. So, anyone who's worried about a significant market drop coming, as long as this continues, it's really hard for the market to go down when there is sufficient inflows of people just buying on a routine basis. You'll have intraday swings, interweek swings, but over a longer trajectory, when you're looking out a year, 5 years, 10 years, it's really just noise. And unless this behavior changes, which I don't think it will, I think if anything, people are more likely to do this even more, because this is just kind of how society works now. This is what people expect. This is how they expect to retire, is investing, via the stock market, via property, investing in property and real estate. And this is just, the norm. This wasn't the norm 30 or 40 years ago, but it clearly is today. And you see it here. I mean, it's obvious. The record monthly inflow was actually April of this past year. Out of the last 3 years, had $12 billion of inflow in April. And this is when the market was getting absolutely smoked at the beginning of April. If anything, this just shows that people throw more money in now than they were, when the market's doing well. The market was getting its ass kicked the first half of April, and people were piling into it. So, kudos to retail for that, really. Let's look at another one here. This is another kind of supply side thing that's happening in the market. And if you're worried about things going down near term, well, just take a look at the 12 leading M2 global money supply. And this is just the 12-week leading indicator. So you can see this is where we are today, but leading out, you can kind of tell that, it's still, the trajectory is either up or neutral. The other thing I have shown here is just stable coin inflows. And this looks a lot like the period that we were experiencing in 2021. And even the crossover here, you could say maybe this is peaking here for the M2 money supply, like it was in 2021. And then you had the crossover where the stablecoin and crypto peaked a little bit later. But this is liquidity coming into the crypto market, and this is liquidity coming into the stock market. Now, will this just be, kind of where it flattened here, but then accelerates? Or will this be a flattening and then a rollover like we saw in 2021 leading into the 2022 bear market, where both of these really rolled over until 2023 when they started to pick back up again significantly. So as long as these two lines are going up, it's going to be really hard for the market to go down, because this is, supply of money that has to go somewhere, whether it's in the crypto market through these stable coins, or whether it's the M2 money supply that's in everything else. Um, that would impact like something like the stock market or real estate. If these are heading up, those markets aren't going to head down because there's just money out there circulating that has to go somewhere. And someone of these people that are getting this money, they're going to put it into stocks. Um, and until there's a major rollover like we saw here in early 2022, I'm not particularly worried about the stock market rolling over. I mean, this and then the steady inflows where people are dumping money in on a regular basis, irregardless of how the stock market's actually performing, make me very optimistic, at least through the middle part of this year and the rest of this year. Speaking of the rest of this year, let's take a look at the S&P performance in years where the return was greater than 5% in May. So we just had a May that was 8.8% was our return for just the month of May in the S&P 500. And you can look back here, there's only a handful of years, there's less than 10 years where this has occurred since 1955. So in the last 70 years, I mean, there may have been years prior to, World War II and during World War II, but I really just wanted to look at, I guess you could say a little bit more modern. I mean, this started before we came off the gold standard, but I did want to capture a few more years. Really, since 80 is where the most of the returns were in May greater than 5%. We only had one time in 55 where we had a return over 5%. But looking forward from May to the full year return, and then we actually have June, so it would be from now until December. Look at these returns. 2009, 20%. 2003, 15% almost. 97, 15%. We had 1980 was 23%. And we had a 9, a 5. There's really only 1 year, and that was 1990, where from this point to the rest of the year, we had a 5% drawdown. I mean, even that 5%, I mean, that would put us at 5% of the year because we're more or less flat on this, S&P 500 this year. That's not a bad year coming off of back-to-back 20+% years. If you're going to give me 50% in 2 years and then take away 5% the next year, boo-hoo. Yeah, I feel bad for anyone who's overly bearish here, because if you're looking for some, 30% drawdown that's going to sustain the period of an entire year, it's probably not going to happen. And the full year returns are even crazier. So a good comparison might be 2009, because if you look at 2009, we were only up 3% headed into June. So just above, right now we're flat. We're down maybe 2% right now. I'd have to go look after today. But the majority of the gains in that year, they were going forward from June to December. And I mean, we've seen that the last couple of years where we have this first half of the year malaise, where retail has somehow outperformed, and then you have institutions try to play catch up second half of the year. And they, the last couple of years, it was things like Nvidia, or last year, end of year, Tesla, where people were in institutional positions were trying to catch up with these outsized gains that were being seen, so that they could explain to the people that are paying them lots of money, like, hey, the SPY is up 25%. Like, how is my fund only up 14%? And I see retail traders are up 50%, because they've been invested the entire year. But this is just paints a pretty clear picture. The average May return in those years was 6.5%. And then going forward on a forward basis through the end of the year, when we had these strong Mays, which is supposed to be sell in May, go away, was 12%. 12% would be good for an entire year, much less just for June through December, or the back half of the year. So this was a very interesting fact. And I mean, there's a lot of green here. You don't see many bad months. Really, the only bad month was in 90. And, if you took out that month, which was the August of 1990, and that may have been, no, that wasn't an election year. But if you took out that month, the year would have been green there too, for the full year. So strong Mays definitively point to a stronger back half of the year and a stronger full year. I mean, the majority of these years, the back half, look at this, 9 to 26%. This the only year where most of the gains on were made in before June, where we had a really strong May. The only year where we didn't see a whole lot in the back half was that 90 year, and the 1980 year we only got 3% going forward. But in 1980 we were already up 23%, heading into June. So I think we might have a year that looks more like this 2009 year, sorry, where we were more or less flat heading into June, and then we had a banger year throughout the second half of the year. And this is all dependent. Like, I don't think tariffs are going to ratchet up to the level of fear that we had seen previously, where we thought there was going to be a 145% tariff on China. I think, yeah, maybe the courts can't uphold this ban to stop tariffs, but any amount of time that it's tied up in litigation where we aren't imposing it, and or the deals actually getting done, and having 10% or lower tariffs on our major counterparties for trade, I think that fear is going to get removed this year for tariffs. I don't think it's that big of a deal. The things I would worry about more would be the job market rolling over, which we're not really seeing yet, and we can look at that. And then like credit markets, which again, we'll look at that too. I'm not really seeing it to a degree that I'd be concerned. So let's take a look there, and we'll start with employment. So right now, current employment is 4.2% in April. We just had the 240K initial jobless claims print today. Continuing claims are around 2K. If we look at a longer time frame, I know people are really looking month to month right now. To me, yes, we've had a slight uptick, and yes, we've come down a lot on the claims. I guess we've gone up a lot on the claims, but down on unemployment. The COVID threw things way out of whack. To me, this looks like a return to norm. And even still, I mean, if you look at the unemployment rate, let's just take a look. Let's look at this month. So right now, unemployment is 4.2%. Initial claims were 240K. Continuing claims were, 19K or 1,919K. Now let's look back in May of 2016. So the same month, 9 years ago. Unemployment was 4.7%. Initial claims were 278K, and continuing claims were over 2,000K. So literally everything was higher in 2016. And if you go back and you look at the stock market, I mean, the world wasn't freaking out because our month over month went up 20,000 jobs for initial claims, continuing claims. And unemployment is still better than it was then. Now, I'm not saying that it will stay this way and it won't roll over, but as of today, with the data that we have, there's really no reason to be concerned about any of these numbers. And I think it's part of why the Fed doesn't want to cut. People were so used to seeing these super low numbers, and they thought it should stay this way. And we have a lot of room here before you start to get really concerned about these jobs numbers. And in a similar vein, if we look at the household debt service payments, so this is just how much people are paying for their debt as a percentage of their disposable income. And we'll look at the same period since 2015. And right now, I think we're at 11.2%. If you go all the way back to the same quarter in 2015, we were at 10.2%. This was at a peak of around a little over 13% during the great financial crisis. The 10-year average is 10.8%, so we're right around that average. The pandemic low was only 9.7%, and that's when people were getting all this stimulus. They had a lot of disposable income. They didn't have a lot of debt because they were able to pay things off. And, we were printing trillions of dollars, at the time, and people were getting checks. So my takeaway from this here and the unemployment data is right now, as of today, I'm not going to try to look forward because I don't know. Nobody has a crystal ball. This is not a reason to be concerned. Um, we're seeing still a pretty good flow, at least going forward the next 12 weeks in liquidity in both stablecoin markets and in the M2 money supply. We're seeing continued inflows into ETFs, even though the stock market hasn't gone anywhere. People are still throwing money at it. For the other chart we looked at, performance when we've had an outsized move like we have in May, greater than 5%. We just had 8.8%. The rest of the year from that point forward, and every year except for like one in the what 8 instances since 1955, we were up 12% from now into the end of the year. And the last thing I wanted to look at to assuage maybe any remaining concerns you had because of the volatility that we were seeing a month ago and the tariff worries that just keep flipping back and forth is we're almost all the way through reporting for the S&P 500 Q1. Sorry, I'm gonna take a sip of beer here. My throat's getting dry. 90% of companies are reported. Of that, 78% have beaten their EPS, 62% have beaten their revenues, and earnings growth has been 13.4%. I think the analysts' expectations headed into Q1 were around 8% earnings growth. So they absolutely smashed. This 13% was way above expectations. And you got to consider that, people were really concerned about, interest rates being held as high as they have been. A lot of people were expecting cuts to start or continue this year. They haven't, and they may not happen at all this year now. Another chart that I could have pulled up, but I didn't, is just to show, the 80s and 90s, especially the 90s heading into the late 90s, interest rates were 4 or higher percent the entire time. And yes, I know our debt was a lot lower. And that's probably an issue that we can just keep kicking down the road as long as we have an Air Force who's got more planes or a Navy who's got more planes than other countries' air forces. That that's really our security when it comes to being the standard for using the dollar, for everybody using the dollar, and to not have major concerns. But you know, I'm not that concerned about interest rates. We had periods where we had great growth where interest rates were a lot higher. Again, see the 80s and 90s. We could, I don't think we should have interest rates at 4.5%. Personally, I think they should be more like 3.5, somewhere in there. With inflation where it is, I know people were worried about it coming up in the latter half of this year because of the tariffs. But I'm a little skeptical that we see that. But we'll see. We haven't seen it yet. And last month, I think a lot of people thought we would see higher inflation, or at least producer prices, because of the pull forward in spending to get ahead of the tariffs, and we didn't see it. So if we're not seeing it there, I don't know that we're going to see it. I think if anything, I'd be more concerned about deflation than inflation. So yeah, 450 out of the 500 companies are reported. We can just go through the numbers here. EPS above the 5 and 10-year average. The magnitude right in line with 5-year, but the last 5 years we've had some crazy earnings. But if you look at the 10-year average, it's way above 10-year average. Revenue beat is slightly down. Again, 5-year average, it's hard to throw in the last 5 years because we had 3 of those years were major boom years. But if you look at the 10-year average, it's more or less in line. The surprise here, a little lower for revenue. That's probably because capital expenditures have been higher, and that's taking away or some of this. And I'd have to look in to see why that is, but it's not crazy off. Earnings growth, strong double-digit growth. I don't have the last 2 years. I just know the number where it was expected to be 8% for Q1. And then revenue, yeah, I'm not really sure what that would be here too. I'd have to go back and look. It didn't pull in the numbers. Um, so the other crucial part of earnings, obviously, is not just what they report, but what the guide is. And this is probably the most crucial. Um, Over half of the companies did provide EPS guidance during the Q1 season. Of those, 139 maintain guidance, 64 raised guidance, and 37 lowered guidance, and only 8 withdrew guidance. And you can see what a percentage is here. It's not, I don't think it's uncommon for like this 8 to withdraw. I will say though, I am a little surprised that only 55% maintain guidance. And that, you know, 15% lowering it's probably a little concerning. I don't know what a typical season is, but these numbers aren't crazy. It's not like everyone lowered guidance. Hell, a quarter of the companies actually raised their guidance, and that's in the face of tariffs. So over half, I mean, you're looking at between those who raised and those who maintained for the companies that actually gave a guidance, that's 80% either maintain or raise guidance. So take that with a grain of salt. Um, but yeah, primary reason for guidance caution, tariff uncertainty. And for all we know, that might be gone, in a few months. And even if it's not, the market is very aware of it. And for the most part, with the exception of the last couple of days where we've gotten some snapback action off of the court rulings, I think it's behind us more or less. The concern now would be inflation and what happens with that and what happens with rate cuts because of the tariffs. That's the only remaining uncertainty. I think the companies, as long as the tariffs aren't, 145%, if they're 10% or less, they can probably work around them without any major issues. So this is my broader view. I don't usually talk about like broader things, but I know I had seen this chart. I think the Compound and Friends had this one. These are two that I always kind of look at, like the debt as a percentage of GDP and then the jobs matrix. I do like to look at them over a longer period because I think people get into this silo where they're looking at it month over month, like for every little tick. Like, we had a tick up, I think it was actually, yeah, where was it at? 3.7, where we went from 3.7 to 4.1, and everybody was freaking out in 2024. Well, guess what? Since December of 2024, for the last 6 months or 5 months, it's pretty much stayed flat. It hasn't gone anywhere. And this is with, a lot of the macroeconomic concerns that we've had. Unemployment, it went up, but it was at 3.7%. That was an all-time low. So I know it's the rule of thumb is if it goes up more than 0.5% or so, it like tends to just keep going. But we've never been coming from a base of 3.5%. And people get locked in the silo of recency bias and they are freaking out over these small jumps in numbers month over month. But if you look back on a larger scale, like it's pretty tame and pretty consistent with what we've seen over the last decade. It's a nothing burger. Like, if everyone didn't look at him, I probably wouldn't look at him. If it wasn't a key driver for rates maybe being cut, I wouldn't even give a shit about this. Like, it doesn't fucking matter. What matters is liquidity is still coming into the market. People are still spending money in the market. People are still investing regardless of what the return is. And unemployment isn't that bad. Like, there's just not a whole lot to worry about. S&P for performance is strong. We had a really strong month, and forward indicators when that happens means we're going to have, almost 100% of time a really strong year. And the one time where we didn't, it was just kind of a meh year. And even that would be fine considering we just came off of 40+% returns over the last 2 years. You're going to have to take some L's every now and then. the market can't just go straight up all the time. So that's my general view. If you want to hear about Circle, I'm going to talk about that. But if you came to just listen in on my thoughts um, on the macro level, just dropouts, yeah, I appreciate your time taking out of your day to listen. And hopefully that can, maybe not decide for you, but give you some, affirmations for us having, a strong market for the remainder of the year. You're just gonna need to shut out some of the noise. Um, Lots of people are on Discord or YouTube or X or Substack or just watching the legacy media like CNBC, and a lot of it's just to get you riled up. But the facts are, there's always going to be something to worry about. But if you look at this holistically with a large enough data set, um, you can also look at TA, which I'm not even going to get into, but we're above an upward trending 200-day moving average. If you look at like the weekly and monthly time frames, the daily time frames, if you just get out of the 5 minute, 1 minute candles, you'll see that we're still, even with the sharp pullback that we had in April, that was solely off of a singular event related to tariffs that may or may not happen, at least to the levels that we thought they were. We're still very much in, an uptrend, even though we basically got into what the definition of a bear market would be. You can have these bear markets within secular bull markets, which I think we are still within. All right, so that's the end of that. Let's take a look at this article that I wrote about Circle. So Circle is one of the few companies that's IPO'd this year. It's also one of the few companies that I think I might invest in pre-IPO. Right now, they've set the price on Robinhood at $24 to $26. We'll just go through what they do, and you can make a decision. I had some money in there for the pre-sale, but I took it out to play calls on NVIDIA earnings. So now that that's passed, I sold those this morning for about 50% gain. I'm going to take the gains from that, and I think I'm going to put it into the Circle IPO. And here's why. So Circle, more or less what their business model is they own a large portion of the USDC stable coin. $60 billion market cap, and I think they own something around 27% of all the USDC. So people give Circle money to like cash USD to buy these stable coins for whatever reason, to use them to trade other crypto assets, more or less to on-ramp them in or off-ramp them into the cryptoverse, the cryptosphere. So Circle takes that money, the cash, I give them $1, they give me a USDC token or coin. They take that dollar and they invest it in US Treasuries at, right now, 4.5%, 4 to 4.5%. So if if USDC has a 60 billion market cap, they own 26% of that. They have several $billion of cash that's been given to them. They park that into a treasury and they generate revenue off of it that way. That is like their whole business model. So as long as the crypto markets are strong, as long as they keep minting USDC, and as long as people keep giving them money to buy this USDC, they can keep putting it into treasuries. And if you look here, I'm just going to look at the tables. I'm not going to read the article. If you want to go in and look at the article, you can. It's on my Substack, Invest with Me, and is on my X at Oshawa Hill. You can see my name down here in my, I guess that's called a badge. What is it called on here? A banner. Or you can do search for Invest with Me on X. It'll probably pop it up too. But looking at the revenues, so in 2024, they had $1.7 billion in revenue. And that was 16% year over year, which is pretty good for a company that all they do is they lend you USDC for your dollars and reinvest your dollars into treasuries. Their net income was 157 million, which is like pretty good. It was way down year over year, and that's because they pay Coinbase a ton of money. And we'll get into that later. But you can see USDC market cap, the transaction volumes here is $25 trillion in transactions since 2018. And with the crypto market um, only going to expand with the new SEC, in my opinion, this is just going to go up. So of that 168 or 1.68 billion, they had to pay Coinbase $908 million in 2024. That is insane. Like, they do make a lot of money, but then they have to give it all right back to Coinbase. And I don't say all Coinbase, but it's a lot of their revenue. So if Coinbase is getting all of this, Circle's making a living, but they're given, they make a dime, their boss makes a dollar kind of thing, and Coinbase is their daddy right now. But it's still a profitable business model. And if you think that companies are going to continue to invest in crypto technology, if you think people are going to continue to use these stable coins to participate in this market, it says here, I mean, their reserves are managed by BlackRock. BlackRock doesn't fuck around with people that they don't trust and that they're going to lose money working with. So this isn't just some random company. I mean, they work with legitimate institutions. 88% of their money goes into treasuries. 12% of it is just cash deposits. And like none of it is in crypto speculation. This company is super safe. And as long as yields are where they are right now for treasuries, they're going to make a ton of money. And if you think the higher for longer narrative is going to continue for the rest of this year, while Bitcoin is trading in six figures, and if we do have an altcoin season, like they're going to make a ton of cash this year. SEC deregulation in the space should only help them. The only concern here would be, the market rolling over. And like I just said, I don't see that happening before August for sure, but not before August, and at least not to a significant degree. And I think it's very, very, very unlikely that in 2025 we're going to see a major rollover. Just looking at the May we just had. So here's their revenue year over year. They only made $15 million in 2020. Going from 15 million to almost 1.7 billion in 4 years is insane. Yeah, their growth is slowing, but they're a mature company now, and you're kind of out of the startup phase. Yeah, I'd say they're a pretty safe company. Yeah, it sucks that 54% of their profit is going to Coinbase, but I think they can afford that as long as the space continues to move up. They could also try to renegotiate that contract with Coinbase. I don't know how much leverage they would really have with them to try to bring that down, but only bringing it down a few percent means that's a few percent to their bottom line. And they were only up 16% year over year from 23 to 24. But if they're able to negotiate 8% and only give Coinbase 46%, then they can get that number. It's a pretty big increase. You're back up over 20% year over year, which would look really good on an earnings report. But yeah, I mean, it's an interesting business model that is very safe, and they're making money. So here's that market share. Sorry, can't talk. 26% of the total market cap of USDC. You can see that Tether. You can see their market share, market cap, and then all the others in the space. So holding 26% of the stablecoin market puts them only behind Tether. which pretty impressive. I think that, yeah, and that it goes back to this number. Stablecoin market cap is going straight up, and that's only going to benefit Circle. I think this is actually a great time for them to IPO with the markets where it is. Hell, you even have Trump's Trump even has a stable coin now with World Liberty Fi, and then Ripple jumping into the space too. So they will have competition, but they have a pretty big head start, and they're only second to Tether. So going forward, it could change, but they're IPOing in like 2 weeks, and nothing's going to change between now and 2 weeks. So this is just where it talks about the rates, where they've been getting a hell of a rate on the money that they're investing, that people are giving them for these stable coins. Based on their IPO price of 24 to 26, I think if they get fully diluted out of the gate, I know ARK is planning to give them $150 million in the initial investment. I think they will sell everything. I think this will be an IPO that they fully sell everything that they have in their S1. And I think there's some additional amounts of like 3 or 4 million shares that if certain things happen that they'll also issue in the S1. But the moral of the story is like 221 million shares. If they are fully diluted coming out of this IPO, 221 million shares at $24 to $26, that gives them a valuation of around $6 billion. If you look at what their market cap would be at $5 billion, which I think at $24, it is around $5 billion. That's a PE of 32. But this isn't a bank. Like if you look at banks, JP Morgan, whoever, PayPal, they're in the teens. Coinbase can be really high, but it varies a lot quarter over quarter. And Circle's not a mature company like JP Morgan and PayPal are. They're still growing 20% annually, and a 32 PE isn't crazy in today's market. It's definitely not crazy. I mean, I think Apple, who hasn't grown in like 3 years, has a PE around 32. So I think it could be a really fair value coming out of the gate. It's picks and shovels playing the finance space. They have a pretty good moat just because of regulatory compliance that they've already gotten established. They are growing market share. They've shown over the last 4 years, and I guess counting this year, it'd be 5 years now. They have a pretty sustainable business model that's growing year over year. Bear case, obviously, 60% of this is going to Coinbase and others of their revenue. That sucks. Interest rates could come down, which would cut it into their revenues. That would suck. But how much of that is offset by the increase in the percentage of the market that they have could offset that too. Very dependent on Coinbase, but I don't see that relationship breaking up anytime soon because Coinbase is benefiting from it to the tune of $1 billion. So I don't see why Coinbase would jettison them as a partner. And then other tech companies, other stable coins coming into the space could take away from their market share. But really, I'm only focused on today. From a fundamental standpoint, from where they are now for the number of shares they're issuing and at the price they're issuing it at. Now, it may not IPO at 26. It could IPO at 30. And if it IPOs at 30, I think it's kind of expensive, but not really. I think for IPO day, if you can get in between 24 and 26, I'll probably set my bid at 26. That's as high as I'm willing to pay pre-IPO, because once you get over 6 billion, if I think it's fairly valued at 5 billion at a 32 PE, over 6 billion, you start to lose some of the alpha. And we've seen how stocks can react after IPO. I mean, just look at CoreWeave right now. I mean, that thing's up like 200% or 100% or something crazy just a few months after IPO. And we've seen even on IPO days, we've seen stocks go up 50% on IPO day. I think Robinhood even either IPO day or like the day after, went all the way up to like $85 after it IPO'd at 35 or 40. And we're in that kind of market right now, and you've seen it in other stocks where euphoria and FOMO and interest in the market is still pretty high right now. And you saw Metaplanet, you've seen some of these other crypto adjacent or Bitcoin adjacent stocks, and even look at quantum right now. There is froth in the market. And I think Circle is a legitimate business that probably is really actually worth around $5 billion. So if you can get shares with the market cap at $5 billion, I mean, would it be crazy for it to go up 50% on IPO day or IPO week because of FOMO and a frothy market? I mean, it'd only be $7.5 billion market cap. I mean, that doesn't seem super crazy for a company whose revenue was $1.7 billion in 2024. I mean, you could guess they're probably going to be over or close to $2 billion this year. So 7.5 billion market cap isn't out of this world. So if you can get in at around 5 billion at market cap at $25 a share, then you can make 50% really quick. If you do it on Robinhood and you sell within the first 30 days, you lose your right to do it again. But if you put in 20K and you make 10K in a day, I think you're probably okay foregoing IPOs for a while. At least that's my stance on it. And if it doesn't, you could have something like CoreWeave, who's beyond 30 days from IPO now and is up, a crazy amount. Now, this is definitely tied to crypto. If Bitcoin is dying a bit right now, it's at $106,000. But it's off its highs of what was like $112,000. I mean, it's a good market for a crypto company to be IPOing into. And I think there's a few other things that I've talked about. You can go and look at my X. Again, it's at Oshawa Hill, OSHUAHILL. Invest with Math, where I've talked about the crypto markets. It's definitely not my area of expertise. You could probably see that in my writing. But the general thesis of the SEC regulations cooling off and major players, Robinhood amongst them, using blockchain technologies, I think it's just going to make the space that much more enticing. And I think companies like Circle and their stablecoin market share could benefit greatly, especially if interest rate environment stays where it is right now. They'll make a ton of money. So I think that'd be a pretty good investment. Well, that's it for tonight. I hope everyone has a great Friday. Let's see, where's the market at right now? I don't even have it up. Shame on me. I swear, I thought I had this. I definitely have this up somewhere. All right, here we go. SPY, it's kind of right around where it's been. Range bound between 586 and 596. It's at 588 right now. Let's look. Ethereum, 2,600. I'm sure Bitcoin's 106K. Nvidia gave back almost all of its gains. It's at 130, almost 138. So it's a little bit higher than it was pre-earnings. And Robinhood, they're getting a discount right now, $63. I'd really like to see that back in the 50s if we could, to add some more. 55 would be great, but I'm not sure that we'll be so lucky, especially considering they have their crypto event coming up here at the end of the month, where I think they're going to do something very interesting with blockchain. What, I don't know, but I think it's either going to be private equity, or I know they've mentioned doing US equities in the European market on blockchain. I think that's the space where they could start small with a few equities, kind of like Kraken is doing, and ETFs. And then it's proof of concept. And if things go well and it works well, and bigger players like JP Morgan see that it's going to work, kind of like they did with 24/5 markets and zero fee trading, it'll get adopted. And once it becomes the norm, I don't think we're too far away from the future of having 24/7 trading. And I think it'll be for everything. Um, everything. Even items that you can sell or trade for stock or trade for money or trade for crypto. Uh, and that's going to be a pretty cool world to live in. And I think Robinhood will be at the forefront of that. I'm always a hooder. That's been my main stock for the last 2 years now. So we'll see. Pretty exciting. Anyways, you have a good evening. Take care. Safe trading out there. Be smart. Don't do anything dumb. The market will have up days. It'll have down days, but over the long period of time, it will go up. And everything right now, just looking at some of the data here, there's really no need to be freaking out, especially if you have a 20 to 30, 40-year time horizon. All right. Take care, everybody. Good night.